As of June 19th, CMHC is going to be increasing their premiums on both the MLI Select and on their standard program.
We wanted to make sure that everybody who is looking at this product as some sort of strategy, that you guys are up to date and aware as to what's going on.
When they released MLI Select, I don't really think they were prepared for how much of a volume increase they were going to get from investors. And I think they have taken this opportunity to realize it's time to maybe increase the premiums a little bit and change some of the expenses.
CMHC essentially has become a staple in the investment strategy or roadmap, and it was always kind of there, but it wasn't as efficient or wasn't always the go-to because of the premium. But now that rates are sky high, it's becoming almost the requirement or the need to exit these projects that have been going on for the last 12 to 24 months. And as Ehren said, the influx of applications that are coming in and the requirement for the knowledge around this topic specifically is extremely needed. We need to be able to have our clients need to have a fundamental understanding of how this works, the advantages and disadvantages of it, and why this is overall going to affect your investment strategies. Hey guys, Josh and Ehren from the Findlay Mortgage Team back at it again with some mortgage knowledge. Today we're actually going to talk about something that's pretty timely. We're going to talk about CMHC and some of the new changes that are happening. So for you guys who don't know, CMHC does make some tweaks every year, but this year they're actually making a handful of decently large changes. So we wanted to make sure that everybody who is looking at this product as some sort of strategy, that you guys are up to date and aware as to what's going on.
Yeah, I think we might have made a couple of reels about this, but we wanted to just sit down and chat about it a little bit further. So as of June 19th, CMHC is going to be increasing their premiums on both the MLI Select and on their standard program, as well as also increasing some of the CMHC base mark expenses that they use when we are underwriting the buildings. So obviously CMHC has been playing a big part recently with this higher rate environment. On the commercial side, it's difficult enough for some of these multifamily buildings to be qualifying with conventional loans when we're looking at amortizations of 25 years and interest rates in and around that 6.5% environment. Right now, with the role that CMHC is playing, we're getting amortizations upwards of 40 to 50 years depending on the program. But more importantly, we're looking at the interest rates that are sitting around right now, benchmark 4.5%. So the amount of volume that's been going into CMHC, especially with MLI Select, has been astronomical. When they released MLI Select, I don't really think they were prepared for how much of a volume increase they were going to get from investors. But the MLI Select program now takes about probably 50, maybe even 60% of the volume of applications. It could even be higher, to be honest. But it's a pretty high amount of the applications going into CMHC, and I think they have taken this opportunity to realize it's time to maybe increase the premiums a little bit and change some of the expenses.
Yeah, for any of you who don't know, one of the major advantages of MLI Select was the rock bottom premium that you would pay. If you had 100 points, it was 1% essentially, which in comparison to where the other regular CMHC product is, you're talking a few points difference, which is massive when you're talking about $2, $3, $4, $5, $10 million loans. CMHC essentially has become a staple in the investment strategy or roadmap, and it was always kind of there, but it wasn't as efficient or wasn't always the go-to because of the premium. But now that rates are sky high, and we're at high sixes, maybe low sevens, depending on the type of asset you have, it's becoming almost the requirement or the need to exit these projects that have been going on for the last 12 to 24 months. And as Ehren said, the influx of applications that are coming in and the requirement for the knowledge around this topic specifically is extremely needed. We need to be able to have our clients need to have a fundamental understanding of how this works, the advantages and disadvantages of it, and why this is overall going to affect your investment strategies. In regards to the benchmark expenses, there's some additional expenses that go into underwriting MLI and CMHC products versus regular conventional commercial mortgage products. These expenses include appliance costs. So if you have an additional appliance or multiple appliances in a unit, we associate a certain cost to it. That's going from roughly $50 all the way up to $60. $60. It may not seem like a lot, but if you have a large portfolio or a large building, this can add and make a difference in your debt servicing. We're also changing the costs for heat pumps. If you are using MLI Select and you're putting heat pumps into your units, it's important to understand there is a total carrying cost in your liabilities that you have to factor in when looking at adding that to your building. When it comes to your overall cost for wages is an additional expense that most regular conventional lenders don't factor in. This is also increasing on a per unit basis, as well as our management cost is going from 4 to 4.25. Again, it may not seem like a lot, but when you're shaving percentages and trying to absolutely maximize your equity takeout, it all does add up. And if you don't get your application in before the 19th, essentially it means all the new benchmark expenses that have increased are going to affect your overall debt servicing, which is going to make your equity takeout and CMHC takeout financing a little bit less advantageous than it was a few days ago.
Continuing off that, taking a look at the increase in premiums. So as John was mentioning earlier, the MLI Select premium at its cheapest at that 100 points was 1%. As of June 19th, the increase is going to be up to 2.55. So they're increasing the premium by 1.55%. So again, on some of the smaller loans, it's not going to be as big of an impact, but when we take a look at the true nature of CMHC and how it's supposed to be used on these larger, 10 million plus type loans, 5 million plus type loans, it's going to make a bit of an impact when it comes to your monthly cash flow and the debt servicing of the building. On the standard side, when we're taking a look at standard rentals, student rentals, single room occupancy type buildings, the insurance premiums are going to be increasing by 85 to 75 basis points depending on the type of deal that we're submitting into CMHC. The standard rental product, the CMHC premiums are already pretty high. If you get that 85% loan to value, your insurance premiums I think are like 5.6 something. So when we take a look at adding another 85-ish basis points to those expenses, you're starting to get into the 6% mark. So that's definitely going to have a little bit of an impact on your cash flow to an already kind of pricey premium. But nonetheless, CMHC is still a product in need right now and a need for a lot of buildings transitioning out of that repositioning debt.
Yeah, and for anybody who doesn't know, for every 5 years in amortization above 25 years, CMHC adds 25 basis points. So if you're going to add, if you want a 40-year or if you want to increase your amortization, you're adding another 75 basis points in premium to your already high insurance premium, which was why we saw a huge push into the MLI product, because realistically you're saving $20,000 in every million. If you're at a $10 million loan, you're talking hundreds of thousands of dollars in saved capital. So I think obviously CMHC caught on. They realized the influx in applications moving into MLI, and they're obviously catching up. When it comes to the rate differential and why somebody would use CMHC, right now we're looking at, again, high 6s, maybe even low 7s, depending on when this is released and when you're watching this. The difference is quite massive. A point and a half, maybe even 2 points, depending on how large your loan is the difference between making numbers work and not work. And I think we're going to continue to see that trend as we move through 2023 and into 2024 until rates maybe stabilize out a bit. As of today, Bank of Canada raised interest rates again yesterday, and the market is pricing in another rate hike or two before the end of the year, which is different from the rhetoric that came out roughly a month ago, 2 months ago. It is an ever-changing environment, and we are seeing cap rates start to actually expand now. We've got some inventory staying on the market for a little bit longer. The appetite isn't as quite there anymore. So I think people are just starting to really dial in on the numbers, and this is a great tool to have in your arsenal to truly understand if you are still looking at the multifamily space.
Yeah, and I think, for those who are in the conversation about rates, something, on a much larger scale that's going to be important to note is that at the end of the year, they are going to be moving away from the Canadian mortgage bonds. So when we're taking a look at our rates right now, it's CMB plus whatever percentage of basis points, depending on whether you're in a 5 or 10-year type mortgage. As of the end of the year, there is going to be a shift away from that. We don't really know where that shift is going to be going. Some have discussed taking a look at GOC and whether it's going to be based off premiums on the GOC. But point is, for those of you that are trying to play the rate game and saying, maybe I'll wait wait to the end of the year to see where rates are at, we really don't know where rates are going to be at the end of the year, especially with this move away. So just kind of keep that in mind in terms of your timelines and your projects and what your goals are moving forwards. There's going to be some changes coming at the end of the year when we're taking a look at rates.
And it's pretty wild that even our lenders don't know. Like, they're not in the know as to what's going to happen with where they're pegging pricing to. So the closer we get to the end of the year, you may actually see some wild spreads in rates just because they're padding their risk. They don't know what's going to happen. CMHC and the government did release something saying that it is going to happen, just whatever is going to happen is still unknown.
Yeah, I think we're already starting to see this too. Like, there's some bigger name lenders out there who might be your more typical multifamily lenders. Some of our bigger investors that we've been talking to, they've already been feeling a little bit of the squeeze on the rates and premiums. And we know just through conversations in the industry that this is due to, like Josh said, padding some of that and de-risking and de-leveraging their portfolio from a lender's perspective. So, for us, that's kind of where we have a little bit of that advantage right now with our lender and what we're doing. And our rates are, a little bit lower, just that risk isn't quite there for our guys. But, keeping that in mind moving forwards, it is going to start to get built in.
Yeah, something to keep in mind is we work with some phenomenal lending partners, and those lending partners have allowed us to become correspondents with CMHC, which essentially what that means is we're able to package up and go directly to CMHC to get your certificate of insurance, which means our communication's a little bit better. It's not a game of telephone, and we actually get some preferred rates. So if you are looking to deal with a firm that specifically specializes in multifamily real estate, and you're looking for someone who has tons of experience with dealing with this multifamily side of stuff and CMHC and answering any questions you might have, we're happy to do so. We're very blessed and extremely happy with kind of where their progress has gone with getting that correspondence. It's not the easiest thing in the world. We're happy to be able to offer you guys some phenomenal multifamily solutions moving forward.
Yeah, a lot of great points. Like Josh said, we have a full product suite right now. So appreciate you guys tuning in. As always, we're here to drop as much knowledge and keep you guys in the multifamily game and try to keep you up to date as much as possible so you can make the most informed decisions. And if you have any questions or comments, either feel free to reach out, shoot us a DM, give us a call, send us an email, comment down below in the chat. We try to get back to everybody as quick as we can, and appreciate you supporting us.